last week I talked about selling equities, also known as stocks, inside an individual taxable brokerage account. And how they are taxed depends on how long you held the securities, also known as stocks. Today I'm talking about the difference between long-term capital gain and short-term capital gain, and how it is advantageous for you to ensure that when you sell your stock, it is under the long-term capital gain. When you sell stocks that you held for more than 1 year, they are taxed under capital gain tax rate. That's only 3 different percentages: 0%, 15%, and 20%. If you merit filing jointly, you can have as much as $0 all the way up to $98,900 taxed at 0% of capital gain, and then between $98,901 to $613,700 taxed at 15%. But when you sell stock that you held for 1 year or less, it's considered short-term capital gains, and that is taxed as ordinary income. That is the same thing as W-2 wage earning income. In that case, your short-term capital gain is taxed under this tax bracket, which has different 7 tax bracket, 10%, 12%, all the way up as much as 37%. So for merit filing jointly, from $0 to $24,800, you're taxed at 10%. From $24,801 to $100,800, you're taxed at 12%. Keep in mind, this is a taxable income. That's W-2 earned income minus applicable deduction, and then now that is your taxable income. The government favors long-term investor. That's why when you hold the security for more than 1 year, it is taxed under the capital gains tax bracket, versus if you hold it for 1 year or less, it's taxed under ordinary income tax bracket, which is much higher. If you recall from the previous episode, I talked about a scenario where person X invested since February 26, 2016, and decided to sell all the acquired shares up to that point on April 10, 2026. That meant for VTI ETF, Vanguard Total Stock Market Index, that person would have profited $24,157, a realized gain of $24,157. But the taxable event, they are taxed differently depending on how long the shares are held for. So any shares that are acquired before April 10, 2025, which makes it more than 1 year, is taxed as long-term capital gain. Any shares that are acquired April 10, 2025 and later is taxed as short-term capital gain, because that is 1 year or less, and is taxed as ordinary income. That's why it is important to pay attention to how long you held the security for, because if you recall, the tax bracket for long-term capital gain is much more advantageous than short-term capital gain. So in this case, 142 shares, or 23,000 of the 24,000 profit is taxed as long-term, and $159 is taxed as short-term. The reason being, if you look at the different tax lot, when the individual purchased every Friday, back all the way from 2016, anything that is more than 1 year is considered long-term. And anything that is 1 year or later is considered short-term. So any share that are acquired April 11th, all the way up to before they sold it, is considered short-term. The dollar amount of the short-term here is kind of insignificant, is in the hundreds. But when you are selling profit that are in the thousands range, it can make a huge difference whether it is a capital gain tax bracket or a short-term capital gain tax bracket, which is taxed under ordinary income tax bracket. So in the next calculation, I will show why that is important for you to pay attention to how long you held the stocks for. In this example, a married couple, filing status is married filing jointly. Their combined income from W-2 earned income is $80,000. And they contribute 6% into 401k, so minus $4,800. I know that when you pay into your medical premium from work, you also get that deducted as well, but because the amount kind of vary a little bit, I'm not putting that in this example. I keep it a little bit simple. And then they don't have any short-term capital gain. Their standard deduction, because they're married filing jointly, is $32,200. They're not taking itemized deduction in this case. So you take their earned income minus their 401k contribution minus the standard deduction, Now the ordinary taxable income is $43,000. So at $43,000 taxable income, the first $24,800 is taxed at 10%. So that's $2,480 for that first $24,800. And then anything above that amount, the remainder, $18,200, is taxed at 12%. So $2,184. And total tax liability for ordinary income is $4,664. Put them at a marginal tax rate of 12%, effective tax rate of 10.85%. Now, if you recall, I said it is advantageous for you to make sure your stocks that you sell is under long-term capital gain. That is because, let's say if you sell stock a profit of $40,000 and it's long-term capital gain, that $40,000 is taxed at 0%. So even though you pull $40,000 profit from a taxable brokerage account, you are still taxed 0% for the $40,000 because it's capital, long-term capital gain. But if you pull the amount and it's classified under short-term capital gain, that $40,000 goes toward your ordinary income tax bracket. Now you have a higher tax bill because it's classified under the ordinary income tax bracket. Now your tax liability is $9,464. Put back the $40,000 in long-term capital gain. If you look at the note here, the way the government determines your taxable income for the capital gain, keep in mind that your capital gain is stacked on top of your ordinary income, and then that's how it determines what bracket you're under. So your total combined, your ordinary income plus your long-term capital gain is $83,000. So that is in between the 0% here. So now that means your $40,000 is taxed at 0%. But if you were to have $60,000 of capital gain, now you see that your stackable income from your ordinary plus your long-term capital gain is $103,000. So that means you're exceeding the $98,900 threshold to be at 0% long-term capital gain. Anything above the $98,900 falls under the 15% rate. That's why $4,100 is taxed at 15%. So that's $615. So you acquire additional $615 of tax liability, totaling up to $5,279. When you're still working and you understand that W-2 wage income and short-term capital gain is taxed under ordinary income tax bracket, and long-term capital gain is taxed at a favorable tax bracket, you can use that to your advantage. Even when you invest in taxable brokerage account outside of the retirement account, you can still pull the profit and still not be taxed as long as you stay under the threshold. So if you look at my note here, when you're married filing jointly for 2026 tax year, your taxable income of $43,000, you can still realize profit, long-term capital gain of $55,900. That's because if you put $55,900, you take $55,900 plus the $43,000 ordinary income, that's $98,900, which is still exactly in the 0% tax rate. So if you are married filing jointly, you have an earned income of $80,000, you contribute $4,800 into 401k, and you take standard deduction of $32,200. Your taxable income is $43,000. That means you have an opportunity to realize your profit to sell your stock, long-term capital gain of $55,900, and that whole $55,900 is taxed at 0% because you're still under that bracket for the capital gain. The tax system I talked about is published by the IRS on a yearly basis. It is well known. It is up to us to read up on it, understand it, leverage it. The rich knows it. They understand it. They took advantage of it. We can do the same too.